In this session, we're going to talk about flexible budgeting and variance analysis. So when we finished with this section, we should be able to identify variances and label them as favorable or unfavorable. We should be able to distinguish between flexible budgets and static budgets in the approach that we take, and we should be able to use flexible budget formulas to construct a flexible budget. We should also be able to compute and interpret static budget variances, flexible budget variances, and sales activity variances. We'll also understand how the setting of standards affects the computation and interpretation of variances, how we compute and interpret price and quantity variances for material and labor, and how we compute variable overhead for spending and efficiency. And then finally, we'll talk about how we compute the fixed overhead spending variance. So we have a lot to cover in this section. We label profit, revenue, and cost variances as favorable or unfavorable depending on the direction of the effect on profitability. Favorable profit variances arise when actual profits exceed budgeted profits. Unfavorable profit variances arise when actual profits fall below budgeted profits. We label profit, revenue, and cost variances as favorable or unfavorable depending on the direction of the effect on profitability, right? So because increases in revenues increase profits, revenue variances work in exactly the same way. Actual revenues that exceed budgeted revenues result in favorable revenue variances, and actual revenues that fall short of budgeted revenues results in unfavorable revenue budgets. However, cost variances work in the opposite way because increases in cost decrease profitability. When actual costs exceed budgeted costs, we have unfavorable cost variances. When actual costs are less than budgeted costs, we have favorable cost variances. The favorable and unfavorable labels indicate only the directional relationships summarized in the charts. They do not indicate that the explanation of the variance is necessarily good or bad. And so a price variance is favorable if the actual price is less than the standard. A quantity variance is favorable if the actual quantity used is less than the standard quantity allowed. A budget prepared for only one level of activity is a static budget. A budget that adjusts to different levels of activity is a flexible budget, sometimes called a variable budget. And so this is the difference between static and flexible budgets. So to develop a flexible budget, managers use flexible budget formulas that describe revenue and cost behavior with respect to appropriate cost drivers. The cost functions are examples of flexible budget formulas. The flexible budget incorporates effects of changes in activity on each revenue and cost. Note that the static budget is just a flexible budget for a single assumed level of activity. A company that has an activity-based costing system with multiple cost drivers will prepare an activity-based flexible budget by budgeting costs for each activity using the related cost driver. And so in this illustration, Exhibit 8-3, we see flexible budgets for output levels of 7,000, 8,000, and 9,000 units respectively. The flexible budget incorporates effects of changes in activity on each revenue and cost. Note that the static budget is just the flexible budget for the original planned level of activity. Thus, the amounts shown in the budget column in Exhibit 8-1 for sales of 9,000 units, the static budget are exactly the same as the amounts in the far right corner or column of Exhibit 8-3, the flexible budget for sales of 9,000 units. Differences between actual results and the static budget for the original plan level of output are static budget variances. Differences between actual results and the flexible budget for the actual level of output achieved are flexible budget variances. Flexible budget variances reflect how actual results deviate from what was expected given the achieved level of activity. The flexible budget approach says, give me my achieved activity level and I provide a budget tailored to that particular level. Actual results might differ from the static budget because of actual output levels were not the same as the static budget, or actual revenues and costs differed from those in the flexible budget for the actual level of output achieved. So here we see an example of Dominion Company and an activity-based flexible budget for the month of ended January 30th, 20X1. And we see where we have the units, we have our sales, right? In the first column, we have actual results at actual activity level. So we have units, sales, variable costs, contribution margin, fixed costs, and operating income. Then we have flexible budget variances. In column 2, we have the flexible budget for the actual sales level. And then, so from the actual results in column 1 and the flexible budget for that actual level of sales activity, we have a flexible budget variance in column 2, which is nothing more than column 1 minus column 3. And then we have the static budget, which is in column 5, which doesn't change, and we have a sales activity variance in column 4, which is simply the difference between the flexible budget in column 3 minus the static budget in column 5. So just as we can divide income into its components minus cost, we can divide the flexible budget income variance into revenue and cost variances. Total flexible budgeted variance is equal to the total actual results minus the total flexible budget planned results. When we talk this sales activity income variance, it informs the manager that falling short of the sales target by 2,000 units explains $18,400 of the shortfall of income relative to the amount initially budgeted, a $5,600 flexible budget loss instead of the $12,800 static budget profit. We can also express this $18,400 variance as the shortfall of 2,000 units multiplied by the budgeted contribution margin of $9.20 per unit. So both static budget variances and flexible budget variances depend on the cost used in the budget formulas. Budget formula costs are standard costs, costs that should be achieved. However, standard costs are defined in many ways by different companies. Many companies set standard cost equal to expected cost, that is, the cost that is most likely to be obtained. However, other companies use a definition based on currently attainable standards, levels of performance that managers can achieve by realistic levels of effort, including allowances for normal defectives, spoilage, waste, and non-productive time. However, depending on what is considered a realistic level of effort and what are normal allowances, currently attainable standards can range from easily attainable to extremely difficult to attain. The level at which standards are set will affect the variances generated and the incentives created. A standard cost is a carefully developed cost per unit. Standards are popular and are used by more than 85% of U.S. companies. An expected cost is the cost that is most likely to be obtained. Perfection standards, also called ideal standards, are expressions of the most efficient performance possible under the best conceivable conditions using existing specifications and equipment. Currently attainable standards are levels of performance that managers can achieve by realistic levels of effort. They make allowances for normal defectives, spoilage, waste, and non-productive time. There are at least two popular approaches to setting currently attainable standards. And so we see here that often there are trade-offs among costs. So improvements in one area could lead to improvements in others and vice versa. Likewise, substandard performance in one area may be balanced by superior performance in others. So when should management investigate a variance? For some critical items, any deviation may prompt a follow-up. However, for most items, managers recognize that even if everything operates normally, variances are unlikely to be exactly zero. For these items, managers specify a range of acceptable variances based on economic analysis of how big a variance must be before investigation would be worth the effort. While the acceptable range is sometimes stated in percentage terms, it is important to also consider the dollar deviation from budget. So when isolating performance, managers try to distinguish between effectiveness, that is the degree to which an organization meets an objective, and efficiency, that is the degree to which an organization minimizes the resources used to achieve an objective. Performance may be effective, efficient, both, or neither. Some organizations compare actual results with last year's results for the same period rather than using flexible budget benchmarks. These comparisons are not as useful as comparisons of actual outcomes with planned results. And so what we see here is a flexible budget variance in detail. And so flexible budget amounts based on $10 per unit of output for direct materials and $8 per unit of output for direct labor. We extend that to get to standard cost allowed, and so direct material cost allowed is 7,000 units times 5 pounds times $2 a pound, which is $70,000, and direct labor cost allowed is 7,000 units times 1/2 hour times $16 per hour, or $56,000. So these are, we've calculated the standard cost, right? So next we're looking at the actual results. Now we're looking at the actual results for 7,000 units produced. And so we have direct material. The pounds purchased and used were 36,800 pounds times $1.90 with a total actual cost of 69,920. For direct material, or I'm sorry, for direct labor, we have the actual hours used of 3,750 times the $16.40 per actual cost per hour to give us a total actual direct labor cost of $61,500. So in the previous slide, we saw standard cost with direct materials of $70,000, and we saw standard cost related to direct labor of $56,000. Here we're looking at actual cost for the same number of units as was used in the standard cost calculation. So flexible budget shows the amounts expected to be spent based on standard quantities and standard costs for direct materials and direct labor to produce the output achieved. And so in this case, what we see is that the flexible budget cost is the standard quantity allowed for the actual level of activity multiplied by the standard price per unit. Flexible budget variances for direct material and direct labor are $80 favorable for direct material and $5,500 unfavorable, respectively. And so what we're saying is that when we get down here into our lower table and we see where we had our actual cost of $69,920 for direct materials and $61,500 for direct labor. We had flexible budget, again, based on standard costs for the level of output achieved. Direct materials flexible budget standard cost of $70,000. We see that we have an $80 favorable direct material budget variance because our actual costs were lower, but we have a $5,500 direct labor unfavorable variance because our actual costs for direct labor were higher by $5,500 than what we expected them to be for an output level of 7,000 units. So we talk in terms of what these variances are, price variance or quantity variance. So the price indicates whether management paid more or less than the standard price for each unit, and the price variance or for each input used. So the price variance is equal to the actual price minus the standard price times the actual quantity used. The quantity variance indicates whether management used more or less than the standard quantity of input for the output achieved. And so our quantity variance is equal to the actual quantity used minus the standard quantity allowed for actual output times the standard price. So if we apply this idea of price variance to the direct materials, this idea of price variance to and quantity variance to direct materials and direct labor, what we'll see is the direct materials quantity variance equals the actual quantity minus the standard quantity times the standard price. So we have a $3,600 unfavorable direct material quantity variance. The direct labor quantity variance is equal to the actual quantity minus the standard quantity times the standard price. So we have a direct labor quantity variance which is unfavorable by 4,000 units, or $4,000. Then we'll move on to talk about the price variance computations. And so if we look at the direct materials price variance, we see we have a favorable variance there of $3,680. And we get to that price variance for direct materials by taking the actual price minus the standard price times the actual quantity. If we look at the direct labor price variance, we see that we have a $1,500 unfavorable price variance there, and that's calculated by using the actual price, which is $16.40, minus the standard price of $16 times the actual quantity used of 3,750 hours. And so what does all this mean? We've calculated quantity variances for materials and labor. We've calculated price variance for materials and labor. So what does all this mean to the analyst? So by definition, the sum of the direct labor price and quantity variance equals the direct labor flexible budget variance. Similarly, the sum of the direct materials price and quantity variances equals the total direct materials flexible budgeting variance. And so what this shows us are the different components of these flexible budgeting variances with respect to either direct labor to the left or to direct materials to the right. And so you can see, breaking these variances down, we're able to tell, well, so is my variance due to a price difference in that what I paid more or less than what my standard price said I could be, or was it due to a quantity or usage variance? That is, I used more material or less material than what my standard price said I would use. And so this, again, this becomes helpful because it provides the management with a tool for investigating, well, how do I either correct unfavorable variances or how do I repeat favorable variances? So by dividing flexible budget variances into price and quantity variances, we can better evaluate managers on variances that they control. Price and quantity variances are helpful because they provide feedback to those responsible for managing input. Managers should not use these variances alone for decision-making control or evaluation. And so this talks to the favorable overhead spending and efficiency variances. So a variable overhead efficiency variance occurs when the actual cost driver activity differs from the standard amount allowed for the actual output achieved. The variable overhead spending variance occurs when the difference between the actual variable overhead and the amount of variable overhead budgeted for the actual level of cost driver activity. And so this is exactly similar to direct materials or to direct labor. It's just with respect now to variable overhead spending and the issue about whether or not we're efficient, right, with respect to, efficiency, or is it spending, right? In theory, it's the same as the material And the labor with respect to quantity and price, it's just now we're talking about with respect to variable overhead, efficiency versus spending. When actual cost driver activity differs from the standard amount allowed for the actual output achieved, we have a variable overhead efficiency variance. The variable overhead efficiency variance arises when actual variable overhead costs differ from the amount predicted for the actual cost driver activity. So the flexible budget based on actual use of the cost driver and the flexible budget based on standard use of the cost driver are always the same because fixed overhead does not vary with the level of use of the cost driver. Therefore, the difference between actual fixed overhead and budgeted fixed overhead is the fixed overhead spending variance. And so this concludes our discussion of Chapter 8 with respect to the flexible budgets and variance analysis. Please do go back and read this chapter and become comfortable with the concepts presented in it and the analysis as we discuss them, and then move on to the discussion forums and the learning exercises. Thank you very much for your time today and listening through this, and I look forward to talking through Chapter 9.